Hi, this is Etienne again. I'm here to talk about different terms of mortgage. By the way, before I continue, always make sure that you follow me, subscribe, so that you get every new video I post, so you get be the first one to receive it. Okay, these are information that is going to enrich your life, that is going to empower you in terms of growth, in terms of your investment goal in acquiring home and property and investment. So always follow me, share the videos too, share it to your friends and family members. I'm here to talk about different terms when it relates to buying a home, getting a mortgage. Sometimes clients don't understand these terms. It's very important that you are aware about these terms. So when you're sitting with your mortgage broker or agent or even the bank, you can know what they're talking about, So now, for example, you buy a home, new home purchase, right? The money you put down, when you make an offer, that one is called deposit. And also, after that is when you put down when you first make an offer. Then, on closing day, the additional money you put down, you give to your lawyer, that is what you call down payment. That is the total amount of down payment you put down, total amount of money you put down, that is down payment. So always know the distinction between a deposit and a down payment. So for example, you are planning to put down, let's say 10% down, but when you offer $500,000 home, so that 10% of that is $50,000. But when you make a deposit, you don't have to put $50,000 down. You can put $5,000, you can put $10,000, you can put $20,000. But that is a deposit when you make the offer. But on closing, let's say you put down $10,000 down on deposit. The other $40,000 on closing, you're going to give it to your lawyer. That is now make up your total 10% you have put down in the house. So always know that. So the deposit is part of your down payment, but it's just a portion of your amount you put down when you make the offer. Now, after your deposit, what is now called is the mortgage. That is the total mortgage you're going to apply for at the bank at that time. Now, when it comes to mortgage, there are different types of mortgages. We have fixed mortgage, we have variable mortgage, and we have a blended kind of in between those mortgages. Fixed mortgage, as the word sounds, is fixed. That means the monthly payment remains the same every month for the terms of the mortgage. Terms of the mortgage, let's say it's 5 years, 1 year, 2 years, 3 years. That is the terms of the mortgage. So that is fixed, no changes. Now, when you talk about variable, just like the name sounds also, variable. So it varies every month. Or sometimes it can stay the same for 6 months. Depends on what the Bank of Canada is doing. So if the Bank of Canada increases, then it will increase too. If it doesn't increase, remain the same, just like what happened a month ago, when Bank of Canada, they did not make any change in the interest rate. They left it the same, so nothing changed. So that one is called variable rate. So it changes all the time, depends on what Bank of Canada is doing. Now, we go back to the blended one, whereby some of them we call it the fixed flex. So it's a combination of fixed, flex. So that means you're going to have a variable mortgage, but the payment itself is fixed every month. So what makes it a variable mortgage depends on what Bank of Canada is doing, is that a portion of your mortgage that goes into the principal and the one that goes into the interest changes, depends on if the interest rate is going up or down, or if it remains the same, so there won't be no change. That's my favorite, actually. I liked it. It's like eating your cake and having it. It's like having the both word, whereby your payment is predictable, the same, but the percentage that goes into the principal interest varies. So that is the big difference there. And the terms of mortgage, I think I mentioned earlier, terms of mortgage term. What do you mean by mortgage term? Is the amount of years that you're gonna have that mortgage before it comes for renewal. So usually it's from 6 months to 5 years. Some of banks are even doing 7 years, 10 years. So most popular one is 5 years in Canada. So after 5 years, you have to renew again, and you renew again. That is a big difference from the United States. In the States, it's 30 years, or 25 years. You don't have to renew every 5 years or every 1 year. You just have one mortgage that will last you for all this time. That is why Americans, they hardly move a lot. They stay in the same place all their life because of that mortgage they have that is going to last 30 years. Of course, they can move and sell it if they want to. Then they're going to, sometimes they don't have to pay penalty in the States. Sometimes they do pay penalty to break it. So that is the difference there too. There's something I want to also mention here. If you already have a home and you want to get into buy another property and still keep that home that you already have as an investment property